People absolutely love JEPI, and that's evident by the sheer growth of the fund and the total assets in such a short period of time. And I think the main ingredients that make JEPI so attractive is the combination of course, the extremely high dividend yield. It's in the double digits right now. The low volatility, which is especially important during rough, turbulent market conditions like we have right now, and that the S&P 500 is the loose benchmark here. So even though this is actively managed, we have some broadly recognizable index, a trusted index to base our expectations off of. Now, if you guys follow the channel, you know that I recently sold my entire position of JEPI after buying it when it was just a few months after the inception date. And I sold it because often when an investment seems too good to be true, there's some hidden caveat that sometimes doesn't become obvious until after something goes wrong. So JEPI generates its high dividend yield via ELNs, which are a pretty complicated financial derivative. Yes, it is limited to only roughly 20% of the overall portfolio, the rest is equities, but still, when I personally evaluate JEPI, it just doesn't fully add up to me. So being that this is 80% equities, we should have roughly 80% the growth of the S&P 500, the stated benchmark, but we don't have anywhere close to that. A fund like XYLG, which is only half equities, has more price appreciation. And in terms of the dividend, roughly 1 to 2% is from the actual equities, but the rest, about 9%, is from these ELNs, which only make up a small portion of the total assets, which means that these must be extremely risky to generate that high level of return. So ultimately, that's why I sold JEPI and now I invest in XYLG. It satisfies a similar role in my portfolio, but it's extremely transparent. I know exactly what call options it's selling, how much, what price point, and according to my analysis with the dividend yield and the price appreciation, this actually adds up. But very importantly, as an investor, I do not play favorites. I invest in what I think is going to give me the best risk-adjusted returns with the characteristics like the price appreciation, the dividend yield that I want in my portfolio. And that's when I came across a new fund in this category, ticker SPYI. This is again based off the S&P 500 with a covered call strategy to boost the income. And right now, if you extrapolate out the dividend yield, it's very similar to JEPI in the double digits. The fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. They take advantage of tax loss harvesting and they invest in specific SPX index call options to have favorable tax rates. And finally, they don't just sell call options, but they also have the ability to purchase index options to help participate in market upsides. So on the surface, SPYI, much like JEPI, is at least loosely based off of the S&P 500, has an insanely high dividend yield, and they capture that dividend yield via a data-driven covered call strategy where they also have the ability to purchase index options. In terms of the holdings, this is the sector breakdown for SPYI, and these are the top 10 holdings. In comparison to the index, SPY, it looks very similar, both in the sectors and at least the top 10 holdings. In contrast, if we toss in JEPI here, JEPI has quite a bit more differences here, both in the top 10 holdings and the sector allocation. Some other important data here is that SPYI is a much younger and smaller fund than JEPI. So the inception date here is August 2022, and the assets under management is only 15 million. Also, the expense ratio is more at 0.68, and JEPI is, I think, 0.35. Yeah, so JEPI is 0.35 with almost 26 billion in assets under management. Although JEPI 2 in its own right is a pretty young fund. And this chart right here is the side-by-side comparison of JEPI in purple, the S&P, the benchmark for both, in blue, and SPYI in orange. And we're looking at the total return, which includes reinvesting that monthly dividend. Unfortunately, we cannot zoom out to the past 5 years because both these funds don't have that much of a history, but we can still learn a few key things from this view. The big one is that SPYI very closely follows the S&P 500. And if we change this view to the price action, which I think is valuable to look at, we can see that SPYI does have more price appreciation characteristics than JEPI. And just for fun, if we add XYLG into the mix, We can see how this compares. So we can see here that just in terms of the price action, SPYI is closer to XYLG than it is JEPI. And if we go back to the total return, which factors in that heavy monthly dividend, this is what it looks like. And technically in this view, SPYI is the top performer, followed by XYLG, JEPI, and then the benchmark way down at 2.16%. And that just goes to show that these covered call funds in sideways moving markets do perform very well, generating that income when you otherwise would have no return. So what do you guys think of ticker SPYI? As far as I could tell, it's similar in behavior to something like XYLG, but the dividend yield is way more closer to something like JEPI. It accomplishes that without the use of complicated ELNs, although the covered call strategy implemented here is more complicated than, say, XYLG, which is fully systematic. Definitely let me know your thoughts in the comments below. If you're still watching and enjoyed, leave a like, subscribe, and I'll see you guys in the next one.